Now, the experts tell us that this is a stock picker's market, and many of them are afraid that investors are opting for ETFs. But if you want to play ETFs from here, which are the ones that have really good upside? To answer this question, we have Alex Vynokur from BetaShares. Alex, thanks for joining us on the show.
Great to be here, Peter.
Now, Alex, just before we start, just tell us the history of BetaShares.
Sure. Our business was founded approximately 4 years ago. The reason why we founded the business is, having looked at the Australian market, we found that Australia has got one of the largest retirement pools in the world. But at the same time, Australia has one of the highest costs of managing money.
Yep.
And we thought that there is an opportunity for not just exchange-traded funds as a way to try to mitigate some of that cost, but really for an Aussie born and bred business that's going to cater to the needs of Australian investors and help them construct more robust, more liquid, more transparent portfolios using ETFs as the instruments.
Okay.
So our business was founded 4 years ago. We are now managing just over $1 billion
Yep.
across 13 different exchange-traded funds.
Okay, and you emphasise the word Aussie. I'm now underlining that word. Are you saying that your rivals in the market are not homegrown Australian companies?
Yes, look, that's a good pickup. We operate in a market where most other players are foreign-owned and foreign-founded.
Yeah.
The differentiating factor for our business in the market is that we build our products for Australian investors.
Yeah.
One of the great things about ETFs generally, and a lot of people associate ETFs with liquidity, with transparency, and very importantly, low cost.
Okay.
I mean, as investors, one of the things we can control, is costs in our investment activity,
Yeah.
and ETFs go very much to that point.
Okay, let me shoot some questions that my viewers will be thinking. Do you have an ETF that approximates the ASX 200 index?
Yes, we do. We have an ETF which tracks the FTSE RAFI 200 index. It's a fundamental index ETF. One of the challenges with the traditional market cap weighted methodology is that generally the more expensive is the stock, the more of it you own in an ETF. So the differentiating factor of QOS, which is our FTSE RAFI 200 ETF, is that you get broad diversification, you get the low cost, you get the transparency and simplicity, but the index weightings are constructed based on the fundamental values of the companies as opposed to purely their market caps.
Okay, so how does that change? Like, for example, if I'm driving home and I'm listening to the radio and they say that the market's up 2%,
Yes.
I often would say to people, well, give or take whatever your fee is, you've made 2% on the day. But in your case, because it's slightly changed around, what would you say would be your gain if the market...
Yes, absolutely. Look, if you look at the track record of that particular index, over time, and we're talking about a decade plus, the historical outperformance of this index has been 2.4% per annum. So if you actually plot the performance of this index against most active managers, you'll find that it will be in the top quartile of active managers. But the beauty of this ETF is that it's entirely transparent, it's very low cost, and it's liquid. So investors can get in and out without locking up their money.
But your ASX 200 index is slightly different from other ones, isn't it?
Yes, that's correct. That's correct. So this FTSE RAFI 200, the fundamental index.
FTSE.
Yes.
Why are you using the word FTSE? We always associate it with the Financial Times index.
Yeah, absolutely. So FTSE is the index calculator in that particular case.
Okay.
So all ETFs, if I can just take a step back, all ETFs in Australia are backed by physical assets.
Yes.
In the case of an equity market ETF, such as the QOS that I mentioned previously, it owns the 200 stocks in its portfolio, but those 200 stocks are weighted not according to market capitalization, but they're weighted according to their economic footprint, which means that over time you tend to be less overweight expensive companies, and you tend to be, in fact, overweight the companies which are a little bit more shunned by the market. And that gives you ability to, to generate additional performance.
All right, okay. And obviously, you should look into the differences between.
Absolutely.
Yeah,
absolutely.
But obviously, you've made that decision on the basis that by doing this, you actually get a better return.
Absolutely. So from our perspective, we believe that Australian investors deserve choice. And Australian investors are obviously building their portfolios in order to produce, performance which attracts them to actually managing their own money.
Yeah.
traditionally, active management is associated with outperformance.
And that's why people can say, oh, it's a stock pickers market. So they're basically saying, forget ETFs, come to me and spend your money with me.
Absolutely. And look, I mean, our view at BetaShares is that it's absolutely not a question of active versus passive. And ETFs are not necessarily always about being passive. A number of investors use ETFs to construct more robust, more diversified portfolios.
There are provocative ETFs.
Absolutely. And just generally speaking, you can be tactical with your ETFs. For instance, we have a financial sector ETF, a resources sector ETF, which allows investors to tilt more towards financial stocks or resources stocks. We've got a yield maximizer fund, which allows people to generate more income out of their portfolio.
For good dividend payers.
Absolutely, absolutely. So that fund owns the blue chips, it owns the top 20. You get all the dividends, all the franking credits, but on top of that, you get the additional income because you're effectively selling some of the future potential gains in the stocks. You still have equity upside in your portfolio, but you're banking the premium up front. So with a product like the yield maximizer, you had income for the 12 months ending 31 December, near 10%.
Yeah.
That's quite a significant income in today's market.
Do you have any ETFs that have an automatic dividend reinvestment plan?
We do, we do. So the yield maximizer fund that we mentioned, it absolutely does. One of our very popular products as well is the Australian High Interest Cash ETF. So that ETF invests purely in at-call accounts with a number of Australian banks. It pays an interest rate which is, after fees, 95 basis points over RBA. That's been a very popular ETF because a lot of investors traditionally have found that they sign up to a rate, they get the great promotional or the honeymoon rate, as they say, and after the honeymoon period expires, the rate reverts back to a fairly unattractive base rate. So the great thing about this ETF, the ASX ticker for that is AAA. Investors can buy the ETF as simply as buying a share, and they get access to a competitive rate of interest on their cash, and traditionally they'll elect into a dividend reinvestment plan.
Yeah, the yield maximizer, what's the fee on that? What's the clip of the ticket?
Yep, it's 59 basis points.
Okay.
So if you compare that fee to an average fee in the active world, where managers often would charge north of 1.5, and often close to 2%, that's where the benefit of an ETF really comes to light. The important thing is that you're not foregoing performance, because the ETFs are built in many cases quite intelligently, and often you capture the same strategy, just in a more transparent, simpler and cheaper way. And this is really what our business is about. I mean, and it's not just our business, I suppose, the ETF industry as a whole is working towards improving investor outcomes, lowering the cost for investors, and providing them with tools, really simple, transparent, and easy to understand tools that they can use to build their portfolio according to their needs.
Let's go through some basic stuff, because you might have got some people interested.
Yep.
ETF stands for Exchange Traded Fund. What's that mean?
Yes. So most ETFs in Australia, or in fact, sort of ETFs in Australia by law, are regulated. So they're regulated by ASIC as managed funds. They are quoted on the ASX, so investors can buy and sell them like any share.
You get the unit price.
You get the unit price. They are backed by physical assets. So importantly, an equities ETF will own the underlying equities in the index, which means as an investor, you get the dividends, you get the franking credits associated. If you look at something like a currency ETF, for instance, it will be backed by physical foreign currency. One of the very popular products in the Australian market is a US dollar ETF. I mean, most Aussie investors who are looking to express a view on the weakening Australian dollar find their way to the bank, and they'll find that the normal bank will charge them probably anywhere between 3 and 5% fee just for the pleasure of exchanging currency. What we provide with the US dollar ETF, which trades on the ASX under the code USD, is ability to access institutional FX rates in a very simple, very transparent and easy to access form. So these are some of the examples where ETFs really provide a value, to the investor.
People who don't aren't confident about ETFs wonder, well, if you went broke as a company, what would happen to their underlying investments?
Absolutely. Look, it's a very good question. It's a question we get asked a lot.
Yeah, why wouldn't you?
And it's very, very fair. So the great thing about ETFs is that they are physically backed in Australia by physical assets. So if you have a market Armageddon, if you have a crash in the market, investors always have recourse to the physical assets that back those ETFs. So that gives them obviously the peace of mind and the confidence. It's not not a CFD, it's not a derivative product, and we've got nothing against those products. Obviously, they may be appropriate to some investors, but ETFs are simpler, they're easy to understand. If you go into the website of BetaShares or any other ETF issuer, you'll typically find significant amount of information down to the constituents that you actually hold under the bonnet.
So the point you're making is this, that where a fund can actually say, and we saw this during the GFC, that we're not able to make payments back to you because of the complications of the GFC. With an ETF, it's going to be listed on the stock market. It might have been 42 when you bought it, and it's now 22, but you can get your money out at 22.
Absolutely, yeah. Absolutely. We have not seen an instance of an ETF not being able to deliver that. Yeah. The reason why they do deliver that is because of the transparency that's inbuilt in the ETFs. You know exactly what's under the bonnet. That's the important thing from the investor's perspective. Yeah. There is no hidden surprises with exchange-traded funds. Yeah. And the simplicity of executing one trade that gives you access, say, to a yield maximizer strategy is really something that resonates with people. I mean, over half the investors in exchange-traded funds in Australia are self-managed super funds. The reason why self-managed super funds use ETFs is because they've made the decision that they want to have control over their own investment decisions. Some people are closer to retirement. They might be building more defensive asset allocation, sort of positions in their portfolios. Some people are further from retirement, and they might be interested more in equities or Aussie equities or international equities. But the great thing is that ETFs are a tool, a very flexible, a simple to understand tool that investors can use to build their own portfolio.
Yeah, okay. Are there any other ETFs that you haven't talked about that people might be interested in?
Look, absolutely. Look, one of the ETFs that's really becoming more and more topical in today's market is a fund called the Bear Fund. Now, what the Bear Fund does, it does not have any leverage, it does not have any gearing, but it allows investors to hedge their portfolios. Okay. In some of the foreign markets, you've got a bit of zang in some of those funds, and sometimes they come in different sort of shapes and sizes. The Bear Fund we've got in Australia is a simple unleveraged investment, but allows people to protect their portfolios. Many people who are managing the tax position in their portfolios and are conscious of tax prefer to use something like the Bear Fund as a means of hedging their portfolio, as opposed to just simply selling out all the stocks, crystallizing the capital gains tax, and then buying them back.
Yeah, and the view is that if the market did fall substantially, the value of that Bear Fund would shoot up. Indeed. And offset some of the losses that you might in your long portfolio.
Indeed. So exactly right.
Okay, mate.
Exactly.
Alex, we're out of time. Very, very informative. Thanks for coming on the show.
Great. Thank you for having me, Peter.
Pleasure.
Cheers.
After break.